on Sky News Business. This is Switzer.
Hello, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and brightest minds in the business. On tonight's show, the stock market once again failed to crack the 6,000 level. So let's try and work out what the market is waiting for. Could it be those Trump tax cuts? We'll see with Michael Wayne of Medallion Asset Management. Now, the stock market once again, as I said, failed to crack the 6,000 level. So let's try and work out what's going on. Are we really waiting for Donald and the Senate to pass those tax cuts, or is there something else at play? Michael Wayne is the founder of Medallion Asset Management. Are you MD as well, Michael?
Yes, I am.
It's good when you're a founder. You can make yourself MD, can't you?
Put any name you want. Call yourself whatever you like.
Okay, fair enough. Now, Michael, we went nicely over 6,000. We seemed to have a real head of steam. Then we went down, but we don't seem to want to leave the 6,000 level behind.
Yeah, look, that's what it seems like. We're having a bit of a consolidation at these levels. There's been a slowdown internationally in the momentum in markets. We've seen commodities come off the boil a little bit, but I do think it is a healthy consolidation, given how far we came very quickly throughout October. There are seasonal factors at play as well. November is the month that three of the big four banks go ex-dividend. That takes a bit of weight out of the market.
It's not a great month in November, is it?
No, it's not typically, but this month hasn't been that bad. And if you look at the markets today, it was the four powerhouse sectors of the ASX that were lower. So you had the miners, the energy companies, the financials and the telcos. All other sectors were higher. And if you actually look at the small cap index and the mid cap index, they were up sort of 0.3 and 0.4%. And that's really, I think, symptomatic of where our market's at the moment. Okay. The major sectors, the major players are struggling, and those more growth-orientated businesses are doing okay. Okay,
well, as you alluded to, international momentum seems to come off the boil. And I guess the obvious question is, are they waiting and hoping that the Senate will pass Trump's tax cuts?
Yep.
And are they also hoping that the tax package is as good as it was once promised to be?
Look, I think that's certainly weighing on markets a little bit, and there's also a lot of economic data coming out of the US this week, but I think that debate is set for Thursday. It should be quite a lengthy debate, and I think markets, it makes sense to, rather than deploy some cash, wait and see what the outcome is of that debate, whether the tax cuts are as juicy for business as expected, and then that might be the impetus to kick us into gear coming into December and that Christmas rally period. But that, I think, is now being factored in by a lot of investors, the fact that those tax cuts will get through, perhaps not fully priced in, but certainly sort of 50, 60, 70% priced in my opinion.
Yeah, if you look at the analysis of the US tax system, you find that most of the experts say that a lot of the big businesses already reduced their tax rate from, what, 30 down to 20 or something like that.
It's like 40, yeah, to sort of mid-20s.
Yeah. In fact, yeah, sure. I think with state taxes, it can be as high as 38, 39%, but a lot of the big companies get it down. But a lot of the small companies don't. They're paying like 32%. So if the corporate rate's brought to 20%, that's where a lot of American smaller cap businesses are going to do. Is that part of the reason why the Russell's doing okay?
That's right. The Russell has been sort of outperforming the S&P 500, and for that exact reason, it's those more internally focused businesses. Many of these businesses are very large by Australian standards, but it's not the big FANGs or the big multinationals that you hear sort of on the day-to-day news. It's not the Apples of this world, the Amazons. It's more the domestic-orientated business, which do feed off the US consumer, which does drive a lot of US GDP growth. So that's a good thing, I think, ultimately for markets.
And it kind of gives potentially more solidity to the US stock market to go up high, because a lot of the high fast growth has come from the FANGs, the high-tech stocks and those really big international corporates. So if all of a sudden the Trump tax cuts provide a lot of strength to the underlying US economy, it's got to be good for the stock market.
That's right. Look, the S&P 500 is trading on a forward multiple of about 18, which is well above the long-term average. And one of the big criticisms some people have had regarding the big rally that we've seen in those major indices is the fact that the breadth of the rally hasn't been too broad-based. It's been driven by a lot of the bigger companies, the Amazons of this world, which have now pushed Jeff Bezos, to $100 billion worth. It's been those major businesses that have pushed the index high, but this, I think, will change that a bit.
Yeah, when he was an investment banker, he put to his boss the idea of Amazon, and the boss said, good idea for someone else to do. Boy, that boss must be really sorry he didn't jump on the Bezos wagon. All right, let's go and look at our small caps. They've been doing well after a shocker period where it was mid caps or big caps. How come the small caps are doing well?
Look, it's just, I think the market has seen some value in that part of the ASX. The fact is, the small caps index, I think, is up about sort of 15% this year, relative to the broader index, which is up sort of 7 or 8%. And a lot of these companies are growing. And the fact is, in this economy, there's not a lot of growth in those largest sectors. It's mainly the IT, it's mainly the healthcare, and these sorts of sectors where the growth has been. And many of the small mid-cap businesses fall into that space.
Are some of the mining services companies starting to be looked at because the mining sector's doing better?
Yeah, definitely. Even the larger cap mining services businesses, Worley Parsons, Monadelphous, have done incredibly well. You can start looking at some of the smaller ones like McMahon's, for instance, Austin Engineering, two of the more favoured ones. And I think with the mining services sector, there's been a lot of flushing out over the last couple of years. Obviously, we had a big downturn in mining investment. Now these mining services companies were competing for a smaller piece of a smaller pie. But I think that cycle's starting to turn. We never see the same sort of investment that we saw in the past, but many of these mines now are in run-off and maintenance mode, and they still require mining services companies to fill the void for that.
And they don't have to impress the market by excessive cost cutting, which
right.
these businesses really suffered. And I know when they were suffering, it was probably a year or so ago, probably when the BHP share price started to spike, I started asking a lot of the people in this program, should we be looking at mining services company? And a lot of people weren't happy to do it. But you looking at the markets over the last, well, you're at least a 10-year veteran of the markets, I would have thought. And I know doing this program for 10 years, invariably the best play is to be the contrarian. So when the big caps are doing well, and I was asking, well, when are the small caps going to do well? That was the time to go in the small caps, wasn't it?
Well, that's right. I mean, some of the multiples, particularly in the mining services space, got well below 10. And the fact is they still were growing their businesses, they still were growing their earnings, and in fact, although they might not have been growing their income and revenue at that point in time, they were certainly growing more market share. There were businesses like Forge Group, for instance, that went belly up through that period, and obviously someone needed to step up to fill the void where Forge was servicing the market. So, as you say, as a contrarian investor, that's the time to step up to the plate. I must admit I wasn't one of the people game enough to get into the mining services, but that is certainly a way to play things. Yeah,
without a doubt. All right, so what do you like about the market? Let me just throw this to you. If Trump gets his tax cuts up, I feel as though that will provide momentum across December. And there is this pattern that December, we call it the Santa Claus rally, it often happens. Do you think that's what we'll see? If tax cuts get up, December will be a strong month?
Yeah, I think so, because global economies are still in a very good position. You look at the US, I mean, their consumer confidence is 17-year highs, their employment rate's very strong. Wage growth has been trending higher since 2010, despite it not really gaining the momentum that we're looking for. Earnings revisions have been higher. Manufacturing PMIs have been very strong as well. And I think that is supportive of markets moving higher from here on in. I think the benefit Australia has is the fact that we haven't had the enormous rally that all the other markets has. We're not trading on the nosebleed elevated multiples that other global markets are. But I think going forward, I'm still going to focus on that mid to smaller cap end of the market, because if you want to be investing in growth, you obviously have to be paying higher multiples given the run that we have, but you need to be making sure you're investing in businesses with a bit more earnings certainty than perhaps in the past, because anything that does miss will get penalised quite harshly.
Do you venture into foreign markets, or you play purely domestic?
I mean, we do play foreign markets for sort of clients with bigger portfolios. We typically do that through the ETFs. We can invest in direct shares, particularly if someone wants some of those bigger growth names, the more common names, the Facebooks, Amazons of this world. But I think you need to be, because when you look at the global markets, Australia makes up, what, 2% of the global market, and more often than not, the growth is coming from other areas as well. So people often balance their portfolios based on sector weightings and things like that, but often you need to weigh your portfolio based on where the growth is coming from or where the options are, and overseas does provide you with a bit more diversity.
For someone like you, and at the moment you're optimistic, I know at times you're happy to be cautiously optimistic, or even a little bit pessimistic at times when I've wanted you to be as positive as I am. But I took heart when Macquarie upgraded its outlook for 2018, and they're expecting at least a 9% rise before dividends. So if we can get a 13% rise next year, would you be happy with that?
13% for the ASX as a whole? Look, certainly I think you've got to take that, particularly if you include sort of your dividends as well on top, that would be better.
It's 9 that they've gone for, plus for 13.
Oh, okay.
Plus,
yeah.
plus your franking credits,
yes,
right?
certainly. And there'll be, look, the thing is, there is a lot of volatility often with something like a Macquarie, and it's often your entry price which determines your result, because the higher the price moves, the lower your expected return is. So with something like Macquarie, if you look back over the last 10 years or so, although it has been an upward trend over that entire period, there has been periods where it's had rather drastic sell-off. So that's where I think you want to be trying to top up on something like Macquarie or something in an equivalent situation.
I wasn't saying Macquarie was saying that Macquarie would be up 9%. They said that the ASX 200 index.
Yeah.
Macquarie tends not to talk about themselves, funnily enough, isn't it? But yeah, that was their view, that the overall ASX 200 could be up 9%. If you throw in dividends for 13, franking credits, it could be a good year for a retiree who just plays like the ASX 200.
Yeah, look, there have been earning revisions coming through, which I think is positive. We have managed to get through the AGM season unscathed, and the outlook has been, in many cases, revised up by a lot of management. So if we can get a clean run, particularly in the early couple of months of the year, then there's no reason why we can't achieve that 13%.
All right, Mike. As always, great to see you, mate.
Thanks.
After the break, could China's debt surge lead to an Australian financial crisis? We'll bring you all the details next.
You're watching Switzer on Sky News Business.